Hello and welcome to the CNBC TV18 special show. I am Farah Bukwala Vora and today I am in conversation with the Managing Director of India's leading consumer company, Godrej Consumer. Thank you, Mr. Gambhir, for speaking to CNBC TV18. We appreciate you joining us today on this show.
My pleasure, Farah.
So, Mr. Gambhir, I'm going to start by asking you about the macroeconomic situation in India. For all along, Godrej Group has always said that they want a government at the helm of affairs, a government that would be a pro-reformist, a majority government. And this election has given the people of India that particular opportunity. Now, what kind of structural changes to the economy do you hope to see under the BJP NDA-led government?
I actually think that this is probably our best chance post-independence to truly attain the promise and the potential that this country deserves. But one has to also recognize that while this is a mandate for development, a mandate for reform, I think the current economic situation is a little bit shaky and wobbly. And so the biggest priority for the new government really needs to be to put the derailed economy back on track. First and the most important one is to actually get the standard goods and services tax implemented by April 1st of 2015. That by itself will be the single most important piece of economic reform.
Sure.
And all other things being equal could actually add about 200 basis points to GDP growth. Secondly, I think the government needs to assuage the confidence of investors by repealing retroactive taxes. At the same time, I think, the ease of doing business in India has fallen quite a bit. India's ranking is about 134. It used to be already quite low, but was 119 a few years ago. But it's gotten worse now.
Sure.
So I think there needs to be some confidence building measures to put in place. The other thing I think is that the government really needs to reduce the minimum alternative tax. That tax has gone up to almost 21-22%.
How soon do you expect to see a revival in sentiment? Because this is something that is going to be crucial to the FMCG sector, which has been grappling with a really severe slowdown over the past 8 quarters.
It will take some time before you start seeing this reflected in FMCG. And the reason for that is we saw a very significant slowdown in FMCG last year,
True.
particularly in Q3 and Q4. Now growth will return back, but typically FMCG tends to be the sector which gets impacted the last when there is a slowdown. Now as the economy turns back, you will see a movement happening upwards, but you need to see economic growth first. I think clearly sentiment will improve and sentiment will go a long way. But beyond sentiment, you do need to start seeing GDP growth rates return back to 6, 7, 8%. I'm very confident that in a couple of years, you will see FMCG growth return back to the high teens.
But it's not going to happen in the short term.
It's going to be quite difficult. I think it's going to be quite difficult for Q1 and Q2. I think for the first 2 quarters, our expectation is that we will continue to see the same kinds of challenges we saw in Q3 and Q4. So for the first 6 months of this year, I think the situation will still remain quite tough. Though I am optimistic that in Q3 and Q4, you will also see a lot more momentum that starts getting picked up.
We were having this very interesting conversation last week where you actually mentioned about this particular phenomenon that's taking place in the FMCG sector, whereby you said that the top 5 players in any category now make up 80% of the market, and the barriers to entry in any segment are firming up. Can you just give me a better sense of what you were trying to say?
It's a bit of a paradoxical situation because if you look at the data, in India, about 10 or 12 years ago, we had about 8,000 brands. Recently, my guess is that number runs closer to almost 13,000 or so brands. So you've seen a proliferation of new brands emerging, particularly at the regional level. So clearly lots of companies are trying to launch new brands. At the same time, what one is finding is that the barriers to scaling up and effectively driving meaningful success are getting harder and harder. One is that whenever the economy starts slowing down, you find that consumers tend to gravitate towards brands that they actually trust.
Sure.
So whenever there is a bit of a slowdown, you start seeing market shares consolidate to the bigger players. The second is that if one has an aspiration to launch a national brand, that is getting very expensive over time. So for any new brand, if they have national aspirations, it would typically cost somewhere between 25 to 40 crores to launch a truly effective national campaign. Now, if you think that in steady state, a company would want to spend about 10% of its revenue on advertising and publicity, which tends to be the norm in FMCG, that would mean that unless you can get to a 300 or 400 crore business or a brand in 3 or 4 years, the economics just won't make sense.
Nearly 1/4 of your incremental sales growth, in fact, came from the launches that took place last year. So I just want to understand that how do you keep feeding this innovation funnel going ahead?
Right.
And will you continue to innovate at the same pace going ahead, or will you wait to sort of reap the dividend out of the launches that have taken place in FY14 or perhaps even in FY13?
Innovation is a lifeblood. So there is no holding back. I think we have to get better and better and even faster innovation. And in fact, you were mentioning 1/4 of our incremental growth. The number is actually almost 40%. So almost 40% of our incremental growth last year came from our innovations. So the innovation story has been extremely strong. See, there are 3 basic tenets of our strategy. One is we fundamentally believe in the power of focus. That we believe that we are much better off focusing in a fewer categories. In those categories, we do want to be the clear leaders. Our belief is that by focusing on a few areas that we are good at, we have a much better understanding of the local consumer, their needs. And so we believe that we can out-innovate our competition much faster in the areas where we have a competitive advantage.
So am I right in understanding that your future strategy would be led by not just deeper penetration but also through brand extensions, a combination of both?
I think we will see growth coming from both penetration and consumption. So let me give you household insecticides as an example, where we have almost 50% of our business in India comes from household insecticides. Sure. In urban India, the penetration of insecticides is about 75%. In rural India, it's at 28%. So the strategy in rural India is going to be to drive penetration through very disruptive innovations. At the same time, in urban India, I think the opportunity is to now drive consumption. In urban India, largely mosquito repellents and household insecticides have typically been used in the evenings. So no longer is it about just evening protection. The opportunity is for all day usage, and the dengue mosquito can bite a consumer both at home and outside of home. So the opportunity now becomes all day usage both in home and out of home. And that's how you will start seeing a huge amount of consumption being driven in urban India. So across categories, I think companies will have to figure out both penetration opportunities and consumption opportunities.
At what point do you see these categories becoming saturated? And at what point will you be compelled to look at other categories? Because again, going back to an earlier point that you made, the barriers of entry or the barriers to entry are becoming firmer by the day. So if you wish to sort of be a part of some category, you would be at that position where you would be considered a late entrant. Are you afraid of that?
Not at all. And I'll tell you why I feel still very strongly that there is tremendous headroom for growth. If you look at the per capita consumption, whether it's hair colors, whether it is insecticides, there's still so much headroom for growth. So across both of these categories, I still feel that there are tremendous opportunities for future growth. At the same time, there are a fair number of newer categories emerging. So a great example is air fresheners. We launched our air freshener Air and that's AER, a little over a year ago. And we're the number 2 player in the automobile fresheners market in about 12 months. It's been a tremendous success. I feel that air fresheners is going to be a new category for the future. We are also seeing a lot of momentum and initial growth in health and wellness. So we launched a new brand called Protect a few months ago. So clearly the strategy is to focus on the core, but over time the definition of the core will continue to expand, and our strategy is to continue finding adjacent categories around the core which might be small today but which will represent future growth platforms. But it is again focusing on these 2 or 3 areas where we have a differentiated position and a competitive advantage. Our strategy again is to build from a position of strength and gradually expand the portfolio through innovations.
So is this to say that you would identify categories which are not currently crowded?
Absolutely. Absolutely. I think the strategy is to find the future growth and white spaces which may be small today, which are high growth, where we can differentiate ourselves and continue to grow those categories and selectively expand the definition of the core by adding these categories. So a good example could be soaps.
True.
Historically, we have always been a
Summer soap.
summer soap, toilet soap, a bar soap player, right? But over time, there are opportunities in winter soaps, there are opportunities in germ protection, there are opportunities in shower gels, body washes, face washes, etc. And maybe in a few years, even skin creams. So the definition of, I think, toilet soap will initially change to skin cleansing, and from skin cleansing, it could even get to skin care. But it's a very calibrated move of selectively going into adjacencies which are related to the core business, because then we can leverage our existing brand platforms. We have a fundamental differentiation that we can build on, and then we have the brand equity which will make consumers also buy these kinds of products from us.
So is this to say that if you do not look at newer categories, will you be looking at inorganic growth to drive the momentum of your growth going ahead?
We are looking at new categories, right? So air freshness is a new category, for instance. Health and wellness as a platform is a new category. So we are definitely looking at new categories, but these new categories are reinforced by our current core business.
Absolutely.
So it's a very selective way of expansion. We are very open to acquisitions as well. We've shown over the last few years as to how acquisitions can effectively drive growth. Over the last 3 years, our growth has been about 28%. Our stated goal this decade is to grow at about 26%. Our belief is that if the economic environment cooperates, we should be able to get growth somewhere around 16 to 18% organically from our current portfolio. For the remainder of the growth, we will have to find acquisitions. Difficult to know when and if these acquisitions happen, but that's the stated strategic intent, is that growth will come from organically, growth will come from innovations, growth will come from the core, selective expansion into adjacent categories, and growth will come from acquisitions as well.
Do you think that when you come to that position where the FMCG market once again comes back to those 16, 17, 18 odd % growth rates, it would be easier for you to protect your market share?
It's never easy. It's always an intense competitive battle which our teams fight on the ground on a daily basis. But to put this in context, see, historically when the FMCG or the home and personal care categories were growing at about 15-16%, our growth rates were above 20%. So we were growing at about 1.6 to 1.7 times the category growth rates. Last year we grew at 15% when the category growth was around 5%. So we in fact grew at almost 3 times the category growth rates in a slowing environment, which just shows how much more stronger we have become through this turbulent time. And so our belief is that if we could show about 3x category growth in a tough environment, we are very well set up to further accelerate and improve our trajectory, going forward. But I think as we look at our business, I think what we normally try and do is achieve growth rates which tend to be about again 1.8 to 2x.
Your international business has also flourished under the 3x3 strategy,
Yeah.
and in fact it now contributes about 47-48% of your total revenues. What's the outlook on your international business going ahead, especially those markets like Indonesia, Latin America and Africa, which have seen a great trajectory, albeit on a smaller base?
Clearly the 3x3 strategy so far has worked reasonably well for us. I think our disciplined focus on finding accretive and strategic acquisitions has been a sensible one. And what is great about this geographic footprint now is that our footprint reaches almost about 2.5 billion people in these geographies. Most of these countries are emerging markets. The potential is as similar as it is to India, high growth prospects, significant emergence of the middle class. So we see very similar consumer demographics in these markets, that similar to what we've seen in India. Having said that, I think a lot of these geographies have seen somewhat similar challenges that India has seen over the last 12 months. Indonesia also has elections this year. South Africa just went through elections, and so typically right before elections, a lot of emerging markets have gone through some turbulence. Our currencies have seen a fair amount of volatility there, very similar to India, right? So I think this is par for the course again. Certainly we expect the situation to improve. Last year was challenging for some of our international markets. This year should hopefully be better. Next year should be even much more better. But the fundamentals are again very intact. Out of our international businesses, Indonesia is about 40% of our portfolio. Africa is about 30%. In both of those, I think, geographic areas, we see a tremendous opportunity for future growth.
Will the rate of acquisitions in these countries accelerate over the course of FY 15-16?
We are ready for more acquisitions, but availability certainly is something which can become a bit of a challenge. But we are very open to acquisitions in Africa, open to acquisitions in Indonesia, other parts of Southeast Asia, and also in India. But it has to be an acquisition for the right reasons. I still think we can grow quite well organically. So inorganic provides the additional juice in the business, but we are quite clear that the acquisitions have to financially make sense, and they have to have the right fit, and they also have to be strategic in nature.
So we've seen FMCG companies grapple with a whole host of challenges, from cost pressures to consolidation in the market, down trading and so on and so forth. But are there any specific new challenges that are now cropping up that you've been able to identify, and whether there are any sort of strategies in place to mitigate those as well?
I think the playing field is getting a lot more complicated. We've always said there is no one India. There are literally dozens of small countries that in some ways comprise this wonderful fabric called India. So one has to get extremely nuanced, which is something which all of us are grappling with, is how to best maximize the potential of mobility and the digital platform, right? We're learning how to really leverage the power of digital media, and digital media in India will evolve very differently than the Western world. In the Western world, you saw an adoption curve started by PCs. In India, I think it will be a lot more centered around mobility. So how we use digital platforms to engage consumers, how do we use it to drive innovation, create meaningful conversations, is something that all of us are learning. And then there is a certain question also about the future of e-commerce. At some point, I think that will get more relevant as far as FMCG is concerned. And this is something that all of us need to start learning and getting better at.
The media space is also increasingly getting very, very complicated. While there are a lot more avenues for you to now advertise, the cost of advertising has become very, very expensive. How do you see this space shape up going forward, and what will you do, especially as this place gets more competitive and you have to keep your voice of share intact?
I think as we are scaling our business up, we are getting far smarter in terms of the way we deploy our marketing budgets. But clearly, I think our intent will be to invest competitively behind our brands and our innovations.
But will your marketing be skewed in favor of digital more as we go forward?
It's bound to happen. So I think, last year we spent about 6% of our advertising budget on digital.
Okay.
That number could go up to about 10% this year. So clearly we will allocate more money towards digital, but the entire advertising budget is going up as well. So it's not as if we are reducing the amount of advertising budgets from print and television, but relative proportions will actually end up changing.
All right, I think that with that I come to the end of all my questions, and I thank you for the time that you've given us today, and I wish you the very best of luck.
Thank you very much. My pleasure.